Welcome investors, traders, anybody else seeking financial freedom. With Brexit hanging around the UK economy at the moment, there's clearly a lot of uncertainty surrounding the stock market, not just in the UK but across Europe and possibly the world, especially with the US government shutdown continuing into its 5th week as of this video. However, there is being progress made, hopefully, with the US-China trade deal, which is pushing up their stock market slightly in the US on the New York Stock Exchange, the Nasdaq, and all of those other entities. After Theresa May's deal was shot down in dramatic fashion in Parliament this week, which was Wednesday the 15th, the markets barely reacted. In fact, they ended the week higher on the Friday the 18th. So if we take a look now at some of the possible Brexit outcomes. So a delayed Brexit in theory should boost stocks in the short term, as it provides temporary respite and allows the FTSE 100 companies to continue operating as usual. So we have a graph here from Schroders, and this shows that 28.9% of the FTSE's 100 primary revenue only comes from the UK, and that's quite a small percentage. It is just over a quarter of their revenue, but then quite a lot of it is made up from Eurozone countries. So obviously you have the United States and mainland China on there, which are bigger than the Eurozone countries, but you do have Germany, France, Italy, Ireland, all in there, which make up a sizable chunk of the FTSE 100's revenue. And a delayed Brexit allows these companies to continue operating as they would under the free trade agreement, which they're used to, and this prevents any potential bottlenecks at shipping ports between the UK and the Eurozone that have traditionally been friction-free, and any trade tariffs that have to be imposed. The Bank of England Governor Mark Carney has come out recently and said that investors are reacting to the increased chance that Brexit is going to be delayed for renegotiation of the deal, which decreases the likelihood of a no-deal Brexit. And I believe personally that a no-deal Brexit would be the worst-case scenario for stocks and shares, both in the UK and in Europe. So what a no-deal Brexit would mean is that a no-deal Brexit means that we'll be operating on the World Trade Organization rules, and so would Europe. And this adds a massive amount of cost to the system that businesses are used to. So, for example, purchasing any goods that from outside the European Union into the UK, or simply from into the Eurozone, must pay a disbursement fee of £11.50. And this is just to simply cover the cost of collecting the necessary taxes from the UK government, and doesn't even cover any of the duty or VAT that actually needs to be paid. And this would work the other way as well. So any goods coming out of the UK to the EU in a no-deal Brexit would be taxed fairly heavily under trade tariffs of the World Trade Organization's rules. And this level of price increase to imports and exports would have a dramatic impact on the ability for these FTSE 100 companies to meet profit targets, as well as other European-based companies to do the same. So that means any companies based in Germany, France, those stock markets, Italy, Spain, the UK, all these countries trading together, the UK leaving would have a huge impact on all of these companies and the stock markets. And I do believe that missing earnings targets because of this would drag the stocks down fairly considerably. And it's not just this that the companies would have to consider, it's the organising plans for transition through Brexit in general and for a no-deal scenario, and the general uncertainty about the direction the UK's economy is heading as a whole in the event of a no-deal situation could cause the stocks to fall as much as 25%, according to predictions from JP Morgan analysts. The markets do hate uncertainty, and that is exactly what we were experiencing in the UK before the PM's deal was rejected. And even though the PM's deal rejection is a surprise to absolutely nobody, and that is why I do think markets haven't reacted massively, is because the price was already factored in, the fear of Brexit, and so nobody was really expecting the PM's deal to go through. So just to have this certainty of the potential for a extended period of time and the much less likely fact that we could experience a no-deal Brexit has boosted stocks just slightly. So on the evening that the PM's deal was voted down, which was January 15th, the market closed at 16,909, which is here. it closed around here for that evening, and so the market closed before the announcement was made, and then as you can see, the morning after the January 16th, the market did drop throughout that day, and on January 16th it closed at around 6856. So that is quite a dramatic drop, and this represents a decrease of around 1%, which I guess actually isn't massively dramatic. It looks dramatic on this graph because it's such a short time period, but in overall FTSE 100 it only lost 1% of the value. And then again the next day, which is January 17th, it looked like it was going to close lower, but ended up staying about level to where it closed on the 16th. And then January 18th, which was the Friday, is where a lot of gains have really been made. So on the 18th it finished at 6968, which just shows how much the markets have rebounded from the initial slight decrease the day after the original Brexit deal was rejected, and this demonstrates an increase of around 2% over the dip that was on the 16th of January, the day after the deal was announced that her deal had been rejected. So that's a 2% increase is a fairly good increase on the FTSE 100 stocks, which are fairly large blue chip companies. So this again shows that the market's consensus is that we are now more likely to get an extension and the possibility of a renegotiation for a deal, rather than a sudden no Brexit situation, which again is the worst case scenario for any investor. So overall, I'm not afraid to hold my investments through the Brexit process, and I'm planning to hold on to all UK investments. So this is simply because the FTSE 100 companies right now are trading at such a low price to expense ratio that the majority of the Brexit fear has already been factored into market value, and if we do have a so-called soft Brexit, there is a tremendous upside to these stocks where they could reach their true value again, and we could gain possibly up to 25-30% according to Citi analysts. So, and that so-called soft deal Brexit is including us leaving with a trade deal and secure and robust plans in place to ensure that businesses do not suffer in the wake of the UK leaving the European Union. However, saying that, there is still a tiny possibility of a no-deal Brexit, and it's because of this, risk tolerance must be factored in here if deciding on what you're going to do. So if you are an investor that there's no way you could face losing 20% of your portfolio value, then it possibly would be wise to invest in other areas such as bonds, precious metals, cash, or simply other markets that have less potential for loss. And if you are going to sell, I would sell around now, possibly, as it looks the market has rebounded quite well, especially in certain stocks like financial sectors, so banking stocks like Barclays, Royal Bank of Scotland, and other stocks such as house builders have rebounded slightly but are still a little lower than they were earlier this year. So in my opinion, I'm going to continue holding all of my stocks and shares throughout Brexit, and I'm confident that there will be a deal put in place, and then there'll be a large upside, as the FTSE 100 at the moment is only trading at 11.4 price to expense ratio and has a dividend yield of 4.5%, which is one of the best index funds you could be in at the moment in terms of sheer numbers compared to the S&P 500 and the Dow Jones. So anyway, thank you for watching the video. Please comment any questions or information you'd like to add. Like the video if you enjoyed it, and please subscribe for more content. Really appreciate it. Thank you.